So everyone loves the idea of building something new. But what if I told you that you increase the chances of losing money compared to buying an existing property? New construction, it sounds super appealing, but it comes with a lot more risk, complexity, and unpredictability as well. I was in the middle of building a 10,000 square foot office and I got caught in around COVID where material costs went up. So today, John and I, we're going to be talking about why we focus on stabilized, value add existing properties. And we're going to be talking about the hidden pitfalls of investing in ground up construction when it comes to multifamily. Now, if you are thinking about investing into real estate, go to fulloutinvesting.com and you're going to find our 10-step full out investing process. And you're also going to have a sample deal there as well. Go to fulloutinvesting.com. John, it's great to be here with you.
Good to be here, Mark. It's probably one of the more frequent questions we get, right? Why do you guys not do ground up development? And, you illustrated a couple of points there in your intro, but excited to dive in a little bit deeper today and share with why we love existing assets.
Yeah, I mean, it's one of those things. It's sexy, right? But building something new, you see a building, you see it, the drawing, and everything is new. It's clean, it's perfect, and But the reality is, by the time you say you get a piece of land and then you put the shovel in the ground and then you build, there's a lot of things that need to happen perfectly in order to be able to hit the metrics. And so this is where we're going to be diving into all the things that potentially can go wrong when it comes to new development. And then on the flip side, why we like the existing buildings where we can go in, we can see it, we can touch it, we can feel it, and we can do all the due diligence on it where we're going in, and how we like to do that and why we like to do that to be able to lower risk. And we're going to be diving into all of that today in the conversation.
That's right. A lot of times, investors, right, they're either looking for cash flow or they're looking for appreciation. And in our world, we say you can have them both, right? And I think that's really the allure of existing buildings that already have proven out their model, right? They're already cash flowing. And maybe there's some operational inefficiency or the units might be a little bit dated. And so we can operate those assets a little bit better than maybe the previous owner and drive up that net operating income, but we're already buying a successful business. And that's how we think about it. When we buy these buildings, we're buying a business. And so for me, it's, do you buy a startup or do you buy a business that's already throwing off profit that just has some opportunity to, maybe improve, right? So a startup, right, where I think you and I both invested in startups here or there, and some have gone well and some have gone not so well, right? And I know you've shared an
Yeah.
example on here of one that went bankrupt, right? And so I think about the complexity also when you're just dealing with a lot of government red tape and bureaucracy, right? And we're going to dive into that specific topic. But even while you're under construction, things can change. And, I heard a story, actually, a friend of mine's in new construction development here in Atlanta, Mark. He works for one of the big multifamily property developers. And what was amazing is they found a little standing water on the property, and by the time the EPA got involved, state regulatory bodies, it paused construction for 9 months just because they had to confirm it wasn't like a wetland or whatever, right? And it's just these unforeseen things can come up. And that's something that's scary for an investor, certainly an investor like me.
Yeah, 100%. And this is where I just we'll just put it out there that you can still make money in new construction. We're not taking anything away from that potential. You can still do it. It's just when we're investing into an asset and when we have investors' capital there, our mandate first and foremost is to protect the capital, to protect the investment. Rule number one that Warren Buffett says is don't lose money, and rule number two is don't forget rule number one. And so when you're looking at we'll say a drawing of a building, and you're compared to an actual building where it's already been leased up, it's already been proven out, and we already know that we can go in and increase the value by doing value add, renovations, valet trash, like very simple value add items. It's all about lowering and mitigating risk. So
That's
that's
it.
really what it's going to be coming down to. You can still do well with new construction. It's just we're going to be diving into minimizing risk and how existing buildings, it does minimize risk at a very large level.
Yeah. So we're going to break this down into 5 key reasons that we at Ferris Capital Partners avoid new construction. Now, as you just pointed out, Mark, it's not to say these are bad deals or bad investments, right? It's just, like anything else, you have to do your due diligence. But for us, the reality of new construction means there's no cash flow for years. In the best case scenario, it can take up to 18 all the way up to 36 months before a single dollar is earned, right? Because not only do you have to construct the building and manage your cost along the way. But then once the building is delivered, you have to lease that property up. And often you don't start breaking even until you're 60, 70% leased up. And so we'll get into market timing in a minute here, but all these factors contribute to where there's just simply no cash flow. And so your investor's capital is effectively sitting idle. It's deployed, but it's not really working for you quite yet. Now, of course, once the property's leased up and if a successful refinance takes place, you might find yourself in the money, but it's just a lot of dead time for income and return on capital, in our opinion.
For sure. And John, it goes back to one of our main rules is we only buy properties that cash flow from day one. And
That's right.
so you nailed it. Do you want appreciation or do you want cash flow? It's like we want both. And
Yeah.
so that's where the value add play is. It gives you such strong upside with appreciation, but it doesn't take away from the cash flow because these properties are spitting out cash each and every month. And so it's interesting that there's some existing value add deals where they're not cash flowing, they're just breaking even. And this is where it comes down to buying in the right markets where properties are cash flowing and there's a value add component where we can go in and we can force appreciation with that as well. So that is a huge mandate for us, John, is we love existing cash flow, but we want that upside, that appreciation as well. And we want to minimize risk all at the same time. And so that's really what it comes down to with the existing buildings. It gives all the above.
Yeah, that's right. Number two, rising costs and potential delays. Now, what we've seen over the past 30, 40 years in the United States and Canada is, the government is getting more heavily involved in zoning and regulations around building. You look back into the 1970s as we came into the 1980s, there was a lot of defective building materials. In fact, there was a famous hotel that was built, I believe somewhere in the Midwest that actually collapsed and 100+ people died. I mean, it was a huge disaster. And so, rightfully so, the government started getting involved and saying, look, we need to kind of tighten this up and make sure that construction regulations are strongly followed. And but then you start getting into what we call sort of the like regulatory costs, right? And so having to factor in, and now all of a sudden, certain municipalities say, well, you have to use this kind of building material, you have to use this kind of brick or this kind of color and the aesthetic choices. And so it's just becoming more and more challenging. Now, more recently, I think people are sort of focusing in on the tariffs as why materials costs are rising. But you mentioned the pandemic, right? We saw how quickly a minor disruption in our supply chains caused long-term reverberations in the market. And inflation was upwards of 8, 10, 12% for a certain period of time. And we're still battling against that inflation today. But the reality is that there's a lot happening just from a global socioeconomic perspective where I just don't really foresee any stabilization with or without the Trump tariffs, right? I think that China's got a lot of problems, Russia's got a lot of problems. And so there's just going to be a lot of pressure on materials costs. And then, of course, labor shortages. I mean, right now in the United States, we have a 4% unemployment rate, right? And so you drive around Florida, Mark, and I mean, you and I have been touring assets and you drive by a new construction, it's a multifamily building being built and there are signs out front saying like $20,000 signing bonus for trades. Like they're desperate to find people to do the work. And so, just all that volatility with the labor shortage and the materials cost just add a lot more pressure and a lot more risk to those deals. And because of that, budgets rarely hold, right? And so, this goes back to you can make money in this, right? And the key factor is making sure you're working with a very experienced, construction company and developer who've done this multiple times and have strong reserves and they're building in contingency budgets for those increases. But you still can't, nobody has a crystal ball, right? You still can't accurately predict exactly what the future is going to bring and what that cost of copper or steel is going to be in the next, say 12 to 18 months. And so if you can't underwrite a budget, you really can't control the supply chain, right? You can underwrite the budget, but you can't control the supply chain. And so that's just another reason that we get a little cautious and why we do not mess with new construction development.
Yeah, and John, I had mentioned it in the intro that like we got caught building one of our office buildings like right in the middle of COVID, and as much as you have a locked in agreement, it's like, hey, these are the new costs now, and it's like you're in the middle of it. You gotta keep going,
Yeah.
and that is now a further injection of cash. And the reality is there's more potential of things that can come up. I mean, you're just think too, you got the contractor, all of a sudden you get in a dispute with the contractor. What happens if they just pick up and take off?
Yeah.
And again, these are all one-off scenarios, but you got a big nut there and there's no income coming in. That's the whole point, is that from the shovel in the ground to like doing all the infrastructure to actually having the building finished, that's one thing, but then the lease up period. And so every day that goes on, you're basically taking another breath of the limited oxygen that you have left, the cash that you've saved, and once you run out, you've run out. Whereas it is existing deal that is cash flowing, is constantly giving you oxygen. It's like every month it's like boom, oxygen, breath is coming in. You're getting more cash flow that's coming in, and you don't have that same kind of pressure that what, we're gonna be running out of oxygen soon. And then that's where potentially you get into these potential capital calls. It's like, hey, listen, this came up, or you had mentioned there was a standing puddle of water and now it's delayed by 9 months. Like, if 9 months addition was not factored into your overall reserves, well, where's that fund? Where are those funds coming from? And then how does that impact your overall returns for carrying costs there as well? I'll tell you, it was not a nice thing going through in the middle, and then all of a sudden materials cost goes up. And it's not like, John, with us with our renovations where it goes up by 10% of like $15,000 a unit, right? Like that we're talking about tens of millions of dollars to build these large assets. A small percentage bump can eat into your profits very, very quickly.
That's right. 100%. Number three is market timing, right? So, one of the things that we love about an existing building is that, let's just say a recession comes that nobody could see coming, right? A black swan event, if you will. If you've got a well occupied building, you can take some action, right? Maybe you moderate your, rental increases that year. In other words, instead of going for 5 or 4 or 5% rent increase, you just keep occupancy tight, but your expenses are still holding, right? So the property is still doing well. And so you can weather that 6 to 9 months of economic downturn and then start reworking your program again. But because the property's cash flowing, it may add a year onto the project. Maybe that 5 year hold becomes a 6 year hold, or that projected 3 or 4 year hold goes to a 5 year hold. But that timing really is also a factor with new construction, because at the end of the day, new construction loans tend to be much higher interest. And so what happens once lease up occurs and you hit a certain ratio,
Mhm.
then you refinance into new debt. And the reality is nobody can predict where interest rates might be in 2 to 3 years. So now that the construction's finished, let's say rates have increased, and if that wasn't properly budgeted in, now all of a sudden you have issues there. Not to mention the fact that just the cost, because of these materials costs, the labor shortages, all the things we just mentioned, new buildings are always going to be at the top of the market for rental prices. And so at Faris Capital Partners, we target these sort of middle market, sort of that working class, middle class market, where we're not trying to get the highest rent in the area. We're actually trying to be kind of the value play, in a sense, where if somebody were, for example, to have a building down the street that was brand new, and then they look at ours and they say, well, gosh, this has all the same kind of like feel of that new building, because it has a beautifully renovated unit with all the bells and whistles that new building is offering. The granite, the stainless steel, great designer lighting and bathroom and kitchen fixtures, but at a couple $100 less in rent, right? So it's that value play. So what we love about that is that we're offering a really great product for that, middle income person. But we're also a great option if there is an economic downturn for maybe that higher income person that's looking to save a few bucks. and maybe cut back on the rent a couple $100 a month, right? So, we kind of are able to compete in any market because we're not at the top of the market. It's like residential real estate. You don't want to be the cheapest home in your neighborhood nor the more expensive, right? And so that's kind of our approach to how we choose these assets.
John, the more we talk about this, the more I'm getting sold on the value add play.
That's right.
These
Yeah,
points are so good. It's like, oh yeah, yeah, that, and I mean the list goes on and on and on. But we're talking about like new construction compared to value add, and it's interesting. You're right about the construction loans being higher. Interest rates will be higher with construction loans, and so that should tell you everything you know when it comes to risk as well. Like if a bank who is we'll call them pros at making money and minimizing the risk, if they're charging higher interest rates for loaning you money on new construction, then, compared to say an existing building that's already cash flowing from day one, well, that should tell you all you need to know when it comes to risk, is they see that as a riskier play
that's
as
right.
well. And so again, this is all about minimizing risk, and then you want to invest for appreciation and cash flow as well. And so that should tell you a lot right there.
Absolutely. Now, with number four, we're going to talk a little bit about tax benefits. Now, of course, the laws are different on the US and the Canadian side of the border, but land and new structures don't offer the same accelerated tax benefits as older properties. In the US, we also have the ability to do a cost segregation study where we separate the value of the personal property against the real property, which creates some additional tax advantages and tax incentives. But even for our Canadians, when you get your T5013, yes, you're showing the cash flow, so that income earned, but because we're deploying capital on the renovations and the remodeling of the amenities, often the expenses are in line or above the income earned. So it just goes back to, because these are already cash flowing and you're getting these great benefits of depreciation, it's just more tax advantage, certainly in those first few years. That eventually catches with new construction, but it just takes a lot longer. So I think those tax benefits are another reason we like those existing buildings.
Yeah, for sure. And then we're going to the next one here, John. We talked a little bit about the financing being a little bit more. Well, we'll say it could be. I mean, it's a few percent more when it comes down to it in general. And of course, every deal is a little different. But when it comes to new construction, it is higher. But the thing that's interesting is when you do your underwriting for this, is that you have to be projecting like 3 years down the road for by the time you build and then you lease up as well. So you're hoping that the market stays the same, because if it starts to turn, that can really impact what your refi loan proceeds are down the road as well. Whereas with the value add deals that we're buying from day one, we can actually go and look and shop the existing rents that we're charging. And then we work based off of those existing rents when it comes down to rent growth. And so that's another thing, is that with the here and now, you get to we'll say, you're not predicting down the road the same way that you are with new construction right off the bat. Your existing rents, when you close, or you already see that that's what they're getting, and you can look at the comparables in around the area to be able to see what is possible in today's market. And then from day one, you can start to execute when it comes down to hitting those projected rents, which tells you if you're on track or off track with your business plan as well.
That's right. And because timing is unknown, right? As we mentioned, things come up. There could be a delay, regulatory, whatever. It's much harder to project IRR and your equity multiple, right? Because, you're not always so sure on the timing, where, in our world, we may decide to exit a deal in year 3 or year 4. We have that flexibility. And for us, it's all about, when can we maximize our investors' returns, right? That's all we're thinking about. So we make those decisions, not lightly, but when it makes the most sense for our investors. But because you just don't know what that timing looks like, and is it going to be 12 or is it going to be 36 months to get to that lease up? And so that makes it even more challenging to really understand your exit strategy, like who are going to be the buyers in 3 or 4 years. Where, at Faris Capital, because we buy stabilized, maybe lightly distressed multifamily buildings in growing markets, with that value add plan, we can more accurately predict in a sense, where the market will be. And it goes back to the conservative underwriting, right? If we think cap rates are going to be 4.8% in 5 years, we're going to project our exit rate at 5.2, just throughout our underwriting, very conservative up and down the line. But it just starts with that monthly cash flow within months, not years. We have fixed rate debt, professional management, conservative projections. And then because of those studies we do, we offer a lot of maximized tax advantages for our investors as well. So, it's for us, it's the biggest balance, or I should say the best balance of risk and reward when it comes to investing in multifamilies in the value add space.
Yeah, for sure. And John, this is actually some really good insight for the listeners that if you are thinking about doing new construction, investing with a very experienced team is critical, critical, critical. And so there was an example 2 days ago. I had actually jumped on with on a Zoom call with an investor, and it came out that he was actually, instead of coming in one of our projects, he was an actual developer, and he was right in the middle of a project, and the project was distressed. So the scenario is there was two guys that built up some like really great net worth. Like they were each worth around 6-7 million bucks, and they were building a multi family development, and each of them sunk in half of their net worth
Mm,
into this project. And so they each had about 3 million bucks in, so 6 million in equity, and they needed another 2 to get it off the ground. But then same with the construction loan, based on the shift in the market, they needed another cosigner to come on as well. And so they were at risk with losing the entire project and
wow.
losing the entire equity in the deal. And so at this point, it came to a point where he wasn't able to find any other investors to come into the deal, and he's got $6 million on the line with it as well. So making sure that you have a project that's well capitalized, that do have massive amount of reserves, but also has the ability to continue the project if there's any sort of issues that come up, that you can actually inject in. And so with this was his very first project, a large development that he's done on. He's built smaller, but he went big with him and his partner on this, and he got caught with it.
Yeah.
And so that's where for the listeners out there, if you are going, you want to make sure that you're with somebody that has our group that has done it. But even still, like there are groups that well-known groups that we've seen that it just went sideways, and if a few projects start going sideways at a time, all of a sudden a well-capitalized group can get taken out very quickly as well, compared to an existing value add deal that is still cash flowing, especially if they locked in fixed debt. It can just continue to weather the storm versus needing this large cash injection in order to get it off the ground.
Yeah, gosh, that's a sad story. I mean,
It
it sounds like
was.
they're still working on it, but
Well,
gosh,
and it
yeah.
was hard. I mean, I'm just there, giving them, the any advice and that came to mind of some different directions and ideas for him. But it was tough being on that call with him, and it was like your heart goes out to him, and he's sharp guy. It was the asset class, it was the market, and it was just some lack of planning of what's the potential downside. And so this is where it goes to me. It's like anytime you look at an investment deal, it's like there's three questions you want to ask yourself. Number one is what's the upside? Number two is what's the downside? And number three question to ask yourself is, can I live with the downside? Can I
Yeah.
live with the downside? And so that's where for us, when we filter that through each of the investments that we bring on, it's like, okay, what happens if this happens?
Mm.
What's the downside? Can we live with that? It's like, what happens if this happens? Okay, what's the downside? Can we live with that? And so that's where for us, it's that filtering mechanism has been extremely helpful to be able to ensure that we're making the right wise choices when it comes to the investment, so that when we offer it to our investors, they know that the deal is vetted and that we've mitigated the risk in the deal.
That's right. And I would say just Mark and I put our own money into every single deal we do, right? And I think that's how we have to ask ourselves that same question, right? Not just as the operator, but also as investors in these deals, right? So we're having that dialogue internally, right? And it helps us make the right decision, right? Which are the type of assets we're going to go after.
Yeah, right on. So just as a recap, new construction, there is more risk, okay? And there's more unpredictability with that as well. And if you want to mitigate risk, then the value add existing buildings that you can go and touch and feel is the safer play. And you can actually balance that really well with finding value add plays where you can go in and be strategic with adding value and forcing appreciation. Similar to how new construction is, you create value, right? So with the existing buildings, you can go in and create value by increasing the net operating income. And so value add deals give you the best of both worlds. They give you appreciation, cash flow, and minimize risk as well. So thanks for listening, guys. If you enjoyed the show, please share and subscribe to the channel where high net worth investors come to look at investing into real estate. We love and believe in you guys. Keep dreaming and investing big.